Hello and welcome to this session. This is Professor Farhad. In this session, we're going to learn about something very important, and that's how to prepare the government-wide financial statement. Throughout this course, we've been talking about governmental funds. So what are the governmental funds? We have the general fund, the special revenue fund, the capital project fund, the debt service fund, and the permanent funds. Those are the different funds that are called governmental fund. Then we have the proprietary funds, which are the internal service fund and the enterprise fund, which I covered. The fiduciary funds I did not really cover. I did not have specific recording for those, but I covered them when I covered all the funds. But I don't have a lot of accounting for them, and you will see why shortly, because they are independent from the government-wide financial statement. But in this session, we are going to prepare the government-wide financial statement, the financial statement for the whole government. So we need to prepare certain reconciliation to do what? To take the governmental funds and the proprietary funds, which is, I'm going to cross out the fiduciary funds because they are independent, they are reported independently. So those two funds, they're going to be prepared into the government-wide financial statement. So although we show the funds separately, then we prepare a government-wide financial statement. So this is what we're going to be doing today. Now, to prepare the reconciliation, there are various steps. So I'm going to break down the lectures into the various steps. So I'm going to do one step at a time, and you'll see how it's going to get done. Okay? So we're going to look at the entity-wide statement. Okay, this is what we're going to be doing. We're going to be preparing them. We're going to see how to do so. So how do we prepare the government-wide financial statements? We're going to convert. We're going to be doing some conversion. We're going to convert government-type funds. So we're going to take the funds. We're going to take the funds, right? We're going to take the funds and convert them to accrual basis. Now, the good thing, the proprietary funds, they're already accrual. Okay, so the proprietary funds, those are already accrual, and those use modified accrual. So we're going to take those funds, modified accrual, and convert them into accrual. Now again, enterprise fund, it's basically done. The internal service fund, we're going to have to make certain adjustments. Also, it's accrual, but you're going to see what type of adjustments we have to make. And what we're going to do, as we do the accrual, we're going to include depreciation, long-term asset. This is what we're going to be doing today. Long-term asset, long-term liabilities. So today we're going to work on depreciation on long-term asset. Later on, we'll work on liabilities. We're going to add assets and liabilities from the internal service fund. So for the internal service fund, you're going to see it's going to be included with those, and you're going to see why. Governmental fund, not why. You're going to see that it's included with those. Okay, because it's considered, basically it serves the government, therefore it's a governmental activity. Okay, and we're going to consolidate fund statement other than fiduciary funds. Notice once again, we don't consolidate those. So this is the overall idea, and this is a picture of what we're going to be doing. First, we have the fund financial statements. We have the five types of governmental fund. Then we have the proprietary funds. Then we have the fiduciary funds. This is the same thing as the first slide. So we have three types: governmental, proprietary, and fiduciary. So those funds here, those three funds, they're going to feed into the government-wide financial statement. They're going to feed into the government-wide. Well, they're going to feed into it, but let's see how and which one. Not all of them. Why? Because once again, the fiduciary funds are not included. So those type of funds, they're not included. Done. Easy. The governmental fund, they used modified accrual. Therefore, we're going to have to do some changes through the worksheet. So we're going to prepare some changes. Then they're going to be accrual. Then they will appear on the financial statement as accrual. The proprietary funds, remember, we have the internal service fund and we have the enterprise fund. The enterprise fund is easy. Why easy? We don't have to do anything. It's going to be shown separately on the government-wide financial statements. Then the internal service fund, remember, the internal service funds gets included with those governmental funds. And we're going to see how. Okay? So we're going to be moving from the modified accrual to full accrual for all funds. Now, we still show all the funds. We still show all the funds at the end of the financial in the financial statement. Let me show you. I want to show you a picture of what we're going to be ending up doing. So this is the city of Philadelphia, and we looked at this report when we looked at the annual financial report. So this is what we're going to be doing. We're going to end up having the primary government. We're going to have governmental activities, which include all the funds, which include, notice, if we go down and we look at the net position, it's going to include net investment in capital asset, restricted for capital project, debt service, behavioral health. So all the funds will be listed here. So we're going to have a governmental column, and we're going to have a business type column. So this is the business type. The business type column here is the enterprise fund, the business type column. Then we're going to have the total. Then we're going to have something called component units, which we have not covered yet. We'll cover later. But this is what we're going to be looking at. Then we're going to also have, this is called statement of net position. They're no longer, it's not called the balance sheet. It's called the statement of net position. Then we're going to have a government-wide, basically income statement, but we don't call it income statement. We call it statement of activities. Okay. So we're going to have also a government-wide statement. And as I said, you still show all the funds in the financial report, but we're going to be consolidating them all in the government-wide. So our job is to prepare the government-wide financial statement. Let's get started. I believe we have a good background information to know what we are doing. So basically, the first thing we're going to do, we're going to focus on is capital asset. Remember that we buy capital assets, such as police cars, property, plant, and equipment. And what's going to happen is, and here we are dealing with anything but the enterprise fund. So any governmental fund, specifically the general fund, they buy assets. And what do they do when they buy asset? When the general fund buy asset, they debit an expenditure. For whatever they buy, they debit an expenditure and they credit cash. So whatever capital asset they buy, vehicle, equipment, warehouse, transportation equipment, bulldozers, whatever they buy, it's expenditure. So now our job is to convert these expenditure into accrual accounting, which is into a capital asset. So here are the steps. So the first thing we're going to do, and I will explain this a little bit further, we're going to, beginning of the year capital asset of governmental fund are recorded net through worksheet entry. So remember, everything that we're doing is, when we do the adjustments, are worksheet entries. Now you need to understand what a worksheet entry is. A worksheet entry does not affect the general ledger of the accounts. It's just a worksheet entry. We're going to do the entry, then we're going to prepare the financial statement that is not going to affect the specific general ledger for each account. What does that mean? It means every year we're going to have to put the capital asset on the books, because the prior year, when we put them on the books, it was a worksheet entry. This year, what we have to do, we have to put the old asset back on the books. So the first thing we're going to do when we prepare the reconciliation, we have to put the prior year, the beginning of the year capital asset on the books plus accumulated depreciation. That's step one. Step two, the balance in capital expenditure. So any place we see capital expenditure on the governmental fund, it's going to be eliminated and replaced with the asset. So remember, when we bought the police car, we only recorded an expenditure. Now we're going to remove the expenditure and record the asset, the vehicle, the police car. Then if we record the asset, then we have to record depreciation. We're going to record the depreciation. Then if we sold any asset, remember when we sold an asset in the governmental fund, we debit cash, for example, 2 million, and we credited an account called proceeds from sale, 2 million. So this is what we did under the governmental fund. Well, guess what? Proceeds from sale, it was an income statement, account revenues and expenditure and changes in net position. But guess what? This is not what really happened. If we sold the asset, we have to credit the asset, we have to credit the capital asset and record either a gain/loss, basically from the sale. So this is what we need to do. So those are the steps. And don't worry, we're going to look at them a little bit more in details through examples. But again, those are the 4 steps. So when you are adjusting capital asset, follow these steps. Okay. Then we're going to work on long-term debt. So this is going to be basically session 2. I'm not going to cover it now. Then we're going to convert other account. That's going to be session 3. So I'm going to break those into various sessions. Then we're going to work on the internal service fund. We're going to work on session 4. So now we're going to work on session 1 alone, and you can ignore this worksheet for now. Okay. So back again to the capital asset. So the first step is to put the asset back on the book. So this is the first step. And for now, ignore this first step. I will do it later. So let's start with the second step. Second step, the balance in capital expenditure is eliminated and replaced with asset acquired. So let's see how we do this. So let's look at this graph, and this graph is going to help us understand what we need to do. So what did we do when we acquired an asset under the modified accrual, when we record this purchase of a police vehicles under the modified accrual? What we did is we debited an expenditure, called it expenditure dash capital outlay 100 million, credited cash 100 million. Now, remember, this is governmental accounting. Now we need to take this governmental accounting modified accrual and turn it into accrual. What do we need to do? If you really think about it, what do we need to do? We need to eliminate this expenditure, because this expenditure should not appear as the end product, and we need to put a capital asset. Therefore, we need to credit. So these are debit, credit, debit, credit. So we need to credit the capital expenditure for 100 million and debit capital asset. This is the worksheet entry. Remember, this entry, it doesn't appear on the financial statements of the governmental fund. It's only a worksheet entry, and it doesn't appear. It appears on the financial statement at the end of the year, but remember, it's a worksheet entry. Therefore, every year we have to put the beginning balance back on the books. So after we prepare this entry, what is the end product? The end product is, what's going to survive is the capital asset. So basically, this capital expenditure we debited, then we credited, and cash will survive because cash is a balance sheet account. Therefore, this is what would appear on the financial statement, which is 100 million and 100 million. This is what would appear under accrual basis on the government-wide financial statement. So we don't show the expenditure, so we eliminate the expenditure. So this is the entry that we make when we buy an asset. This is the entry to put the asset on the books, on the government-wide financial statement. Now, once we put the asset on the books, we have to book depreciation. Now, what entry of depreciation did we book under the governmental fund? And the answer is no entry. Remember, the governmental fund did not have the asset, therefore did not depreciate anything. Therefore, we don't have any depreciation. So what entry do we need to make to book the depreciation? Simply, we're going to book depreciation. How do we book depreciation? Hopefully, you know how to do this. Debit depreciation expense, 10 million. Credit accumulated depreciation, 10 million. So this is the entry that we make on the worksheet. Then what survived is the entry. With that, what's going to happen? The end product is we're going to show the depreciation expense of 10 million on the government-wide financial statement and accumulated depreciation of 10 million. Now, sometime what we do is we sell an asset. How do we recognize an entry when we sell an asset on the governmental-wide financial statement? We debit cash of 60 million. We credit proceeds from sale 60 million. So we sold some assets, and this is what we do. Now we're going to have to convert this entry into accrual basis. We're going to have to convert it into accrual basis. Proceeds from sale should not be there. So we need to debit proceeds from sale, which is, it's a government fund account. So we need to debit proceeds from sale, and we need to credit the capital asset. Since we sold the asset, we need to credit the capital asset. Here we're going to assume the capital asset has a cost of a book value of 45, and since we sold it for 60, we have a gain of 15. So what survived at the end of the day? The cash, 60 million, survived. The proceeds from sale, we credited, then we debited. This is gone, and what's left is the capital asset and the gain. And this is basically, hopefully you see how we prepare those journal entries. So what did I show you now? I showed you those 3 steps. Step 2, 3, and 4. Now, why did I show you step 1? Because step 1 is to put the beginning balance of capital asset, because every year we have to start by putting the beginning balance capital asset, because every year the worksheet are eliminated. Basically, they don't go on the general ledger of each account. Okay, so those are the entries that we need, and this is the entries that I just showed you. Debit capital asset, credit expenditure, debit depreciation expense, credit accumulated depreciation, debit the proceeds, credit the asset, and credit either a gain, or this could be a loss, by the way. Then therefore you'll have a debit. It doesn't matter, a gain or a loss. So this is what I showed you. The only thing I did not show you is step 1, which I'm going to show you in an example, because it works better in an example. Okay, so on step 1 you have to put the beginning balance of capital asset, because on the worksheet they don't appear from year to year, therefore you have to put them down. So the best way to do this is to do what? Is to actually work an example, I'm not going to work this whole example because part of this example belongs to another session. So I'm going to work some parts of it now, and we'll work the other parts later. So the city of of Grinder Switch maintains its book in a matter to facilitate the preparation of fund accounting financial statements. So when they prepare the fund accounting, obviously they do what? They use modified accrual and uses worksheet adjustment to prepare the government-wide. So what they do, then they use the worksheet to prepare the government-wide financial statement, to prepare the adjustments. You are to prepare in a journal form, worksheet adjustment. We don't have the complete worksheet, but you're going to see what the adjustments would look like. So, general fixed asset at the beginning of the year, which has not yet recorded, were as follows. So remember, those assets, they don't appear every year, because now last year they appeared. So land, building, improvement, other than building, equipment, accumulated depreciation, those they appeared on last year government-wide financial statement. That's what, because we did the journal entry and then they appeared on the statement, but they were only recorded in the worksheet. Therefore, what do we have to do this year? We have to put them back in the government-wide financial statement. So we have to start with the beginning balances. So those are our beginning balances in capital asset. So the first thing we have to do, we have to put them back on the books, and we'll see how. This is basically what I told you, step one, and hopefully it will make sense once you do it. Transaction 2, during the year, expenditure for capital outlay were 7.5 million, of which 480 was for building and the remainder was improvement other than building. Now we added capital asset, but what did we do when we added them? We treated them as expenditure, so we need to make an adjustment for this. The capital outlay in step 2 were completed at the end of the year and will begin to be depreciated next year. So we have to start the depreciation. For purposes of financial statement, or capital asset are depreciated using the straight line, no salvage value. Building is 40 years, improvement other than building 20 years, and equipment 10 years. So we need to depreciate them. And in the government fund financial statement for revenues, expenditure, and changes in fund balances, the city reported proceeds from the sale of the land of 600,000. So they sold the land, which had the cost of 505. Then transaction 5, 6, and 7, they belong to another session, which is in the next session. So the first thing we do, we're going to prepare the appropriate journal entries to convert this governmental fund financial statements activities into government-wide accrual financial statements. Okay, so let's go ahead and get started. So I'm going to use, basically, I would use Excel sheet to do this, so you will see what's going on. So let's look at step 1. Step 1, it says, basically step 1, let's go back and read step 1. Step 1, it says, beginning of the year capital asset of governmental activities are recorded through worksheet entry. So that's the first thing we need to do. And the shortcut is, it says debit capital asset net, which is assets minus accumulated depreciation, and credit net position at the beginning of the year. So let's go ahead and prepare this entry. Okay, so we need to add all these assets in step 1. We need to add all these assets and their accumulated depreciation. Then the difference goes into net position. So let's go ahead and do so. So I'm going to debit, we're going to debit land, we're going to debit buildings, we're going to debit improvements other than buildings. Again, why are we doing this? Because every year we have to do this, because these are worksheet entries. They don't appear in the general ledger. They don't appear in the general ledger. Then we're going to have to credit accumulated depreciation. So let's go ahead and do so. So let's see, look at the numbers one more time. Okay, copy them down. Let's go ahead and go through them. So 76. This is the debit. $33,355,000, 14,820,000, equipment 11,554,000. Okay, and we're going to have to credit accumulated depreciation, and that's the credit. It's 25,300,000. 25,300,000. Let me just add them. Okay. Now, I put the asset on the books and I put accumulated depreciation. Now, as simply put, what I have is I need a credit, and the credit should be the difference, which is 42,119. So let me see if those equal to each other. 67,419. 67,419. So basically, the net position is added. Net position is credited for the difference between the asset and accumulated depreciation. So what we did in this entry, we recorded the beginning balance of capital asset. Recorded beginning balance of capital assets. Because what's going to happen, next year we have to do the same thing, but the balances will be different, okay? This is a worksheet entry. That's how we have to do it every year and adjust net position. Adjust net position for the balance. So that's a step one. We completed step one. Step two, during the year, we purchased 750, of which 480 was for building. So what did we do when we bought the building? What did we do when we bought the building? We debited expenditure, dash building. Let me do it on the Excel sheet. So I'm going to do this on the side. So what did we do? We debited expenditure for the building, expenditure dash building. It's hard to type. And we debited expenditure dash improvement other than building. So those are the two accounts that we debited when we credited cash for the 7.5 million. So 7.5 million. The building was for 4.8 million. And the expenditure for the improvement other than building, 2.7 million. Now I need to eliminate this. I need to eliminate the expenditure and put the building and the improvement on the financial statement. Therefore, I will debit. This is step two. I'm going to debit the building, which is this account here, buildings, which is basically what I'm doing. I'm adding to my buildings account. So I'm adding, let me just show you here. I'm adding, see this account here, building, I'm adding more to it. I'm adding to my building, 4.8 million. I'm adding to it. I'm adding to my improvement other than building, 2.7. And what do I need to do? I need to remove my expenditure. So I need to credit expenditure building. I need to credit $4.8. I need to credit expenditure improvement 4.8. $2.7, I meant to say, not 4.8. This is for the building. And what I just did, I performed step two, and step two is to add the new capital asset. New capital asset. Again, this is only a worksheet entry. So notice this is what we did under the governmental, and I had to remove them. Therefore, I need to credit those two accounts, which I did, and debit actual building and actual improvement other than building, two new assets. So step one is done. Step two is done. So this is basically an example of step two. Okay, step three. we needed to depreciate them. So basically we're going to depreciate using straight line. Building 40 years, so we have to take whatever we bought in the building and we depreciate it over 40 years. Improvement other than land, other than building 20 years, and equipment 10 years. Now we have to compute the depreciation. It should be easy, but we're going to have to do it anyway. So let's go ahead just to show how it works, because now we need to book depreciation expense. Okay, so basically we're going to have to book depreciation expense, and we're going to have to credit, because we have three different assets: accumulated depreciation for buildings, accumulated depreciation for other than building, improvement other than building, and we have a third asset, which is equipment. Okay, accumulated depreciation equipment. Now we need to kind of basically compute the depreciation. So basically the buildings are depreciated over 40 years. So if we take this number divided by 40, that's going to give us 833. The equipments are depreciated over improvement other than building. This is 20 years, and equipment 10, and equipment 10 years. Okay, now we can add all of them as depreciation expense. Okay, so this is the depreciation expense. This is basically, if you want to think of it as step 3, Okay, so this did not appear on the governmental fund, therefore there is no entry. The last entry that we're going to make in this example is to book the sale. So we sold a land for $600,000, has a residual cost of $505. So what did we do under the government fund? We debited cash, 600. We credited proceeds from sale, $600. This was the entry that we make. Now what do we need to do with this? We need to, the cash is going to be the same. So let's start with cash. The cash will be the same. The cash is going to be credited 600,000. Now, since we sold the land has to be credited as well. So we need to credit land, and we need to credit land at cost. And they told us the cost of the land was 505. So we bought the land at 505. It has a cost to us at 505. So we're gonna the cash. I'm sorry, the cash is not affected. Yes, the cash is not affected. It's gonna be the same. So we credit land. What do? We need to debit the proceeds from sale. Proceeds from sale, which is this account here, need to be debited 600,000. Let me use 600,000 so I don't confuse you. 600,000, one more zero. 600,000 in cash is debited. Cash doesn't need any adjustment because it's going to appear. So notice what we did here. This account here, proceeds from sale, was credited. Now we need to remove it. Now the difference is what? The difference is we had a gain on this land. So we're going to book, gain on sale of land, which is a special item. Gain on sale. And we made a gain of 95,000. Now the gain appears on the government-wide financial statement. All right. So hopefully what we did in this session is I just had an introduction of the how to do the reconciliation. Okay, and I work only on one type of reconciliation, which is I only reconcile the capital asset through those 4 steps. Those are the 4 steps. Now, is this the only reconciliation we have to do? Not at all. We have kind of 3 more sessions. The next session I'm going to work on is how to put long-term debt on the financial statements, on the government-wide financial statements, because that's something that doesn't go on the governmental fund. Governmental fund don't carry long-term asset, which is capital asset, and don't carry long-term debt. The government-wide financial statements, we have to reconcile those. But remember, those are what? Those are worksheet entries. So every year we have to start from the beginning. If you have any questions, any comments, by all means email me. But this is going to be a series of lectures covering the reconciliation, so you have to watch all of them to get the complete picture. Study hard.